Good afternoon, everybody, and welcome to the halftime report for 2017. I'm Jim Cruzan, and this is the tale of two markets. We're not really going to cover a lot of ground today. We're simply going to talk about the past, the present, and the future. 2017 so far has been the tale of two markets. Barron's recently explained, bond prices reflect an economic slowdown. Stocks reflect economic growth. This is not to suggest that a major correction is looming. It is meant to highlight that too few investors seem focused on multi-market narratives of falling bond yields and rising prices. So who is right? Today, we're going to take a look at the stories of stocks and bond markets and what they've been telling us in 2017. Then, we'll talk about where we are today and where we may be heading in the future. One of the things we know for certain is that our understanding of the world around us depends a lot about how we read and interpret data. Obviously, there's a lot of different ways to interpret the same information. Our agenda today, as I said, is really short. We're going to talk about where we've been, where we are, and where we may be going. Before we get into the nitty-gritty of the presentation, I thought it would be a good idea to kind of warm our brains up by looking at some maps of the U.S. and seeing if we can figure out what the data is telling us. This one is somewhat straightforward. What do you think it says? Well, I'm not going to keep you in suspense. This is a Thrillist map, and it represents noteworthy restaurant chains by state. Now, noteworthy can mean it's the largest chain in the state. It may be where the restaurant was founded or where it's presently headquartered. Illinois, clearly McDonald's, as it originated in Oak Brook, and Michigan, we see Domino's Pizza. Here's another one. This one's a little bit more difficult. If you look at the source, you might get a hint. This map is actually from the Washington Post Wonk blog. It identifies Americans' preferences by state. States that prefer one object are marked in shades of green, and states that prefer another object are marked in shades of purple. Again, the source may very well be a big hint. This graph shows the preference of ownership between cats and dogs in the U.S. As we can see, the southern states and Montana tend to prefer dogs. Massachusetts is the most cat-friendly state in the nation. In fact, according to the Washington Post, in terms of raw population in Massachusetts, cats outnumber dogs by nearly 2 million. Why? One simple explanation is that cats are more compact. You can fit more cats in a house than you can, say, golden retrievers. This map comes from The Economist. It's a little bit more complicated. It shows sightings per 100,000 people, and the number increases significantly during drinking hours. People in Washington, Montana, and Vermont seem to see more than other folks in other states. Do you have any idea what this might be telling us? This chart represents UFO sightings. The Economist noted that effectively UFO folk tend to be really great visitors. And they're great visitors because they tend to show up in and around cocktail hour. You rarely ever see them during the day, and they rarely ever bother us during sleeping hours. How else could this map be interpreted? All right, let's try another one. This map is from the American Enterprise Institute. Each state is color-coded and contains the name of another country. So what do you think it's telling us? This map gives us a fresh perspective on the size of the U.S. economy by relabeling states with the names of countries with similar productivity. For example, in 2015, America's largest state economy was California. It had productivity that was roughly on par with the country of France, and would be the 6th largest country in terms of productivity in the world if it weren't part of the United States. Texas would be number 10 with a GDP of roughly that of Canada, and New York would be 11 with a GDP similar to South Korea. The map also notes Michigan's GDP similar to that of Poland. Okay, this is the last map. Note that each state has a dollar amount attributed to it. Can you tell me what this represents? This map shows the relative value of a dollar in each state. This comes from the Tax Foundation. Regional price differences are strikingly large. Real purchasing power is 36% greater in Mississippi than it is in the District of Columbia. In other words, if you have $50,000 of after-tax income in Mississippi, you would have to have after-tax earnings of $68,000 in the District of Columbia to afford the same overall standard of living. The issue with data is not everybody interprets things the same way. So let's review some data and kind of see where we've been. As it turns out around the world, people share a bias when it comes to economic data. Economic optimism on the vertical axis and economic growth as measured by GDP is on the horizontal axis. GDP rates show that increases or decreases in values of goods and services purchased in each country. As the economist mentioned, data compiled within specific countries suggest that economic optimism may not have much to do with the economy at all. A Pew report finds that respondents whose preferred political party is in power tend to be more optimistic. For example, Venezuela's GDP is expected to plummet by over 7% this year. Food shortages are so severe that 3/4 of Venezuelans have lost weight involuntarily this past year. Nonetheless, 49% of left-leaning Venezuelans who tend to support Maduro, the country's president, thinks the economy is performing just fine, compared with about 11% of the conservatives. In the United States, the bias is most obvious in consumer sentiment. Every month, the University of Michigan completes a survey of consumer attitudes and expectations, which are used to evaluate economic trends and prospects. During the 2016 election year, they uncovered a significant divergence in economic expectations. The chart shows here a change in consumer expectation before Presidents Reagan, Obama, and Trump were elected. In 2016, the difference in opinion about where the economy was heading were far larger than in previous election years. Notice the Reagan years. That is not a mistake. After Reagan was elected in 1980, Democrats expressed more favorable expectations than they had the previous 6 months, while Republicans expressed less favorable expectations. The director of the survey explained this data as it relates to Trump by stating that Democrats anticipated an imminent recession, and Republicans expected a new era of robust economic growth. So how has the U.S. economy actually been doing? We have been experiencing slow but steady growth in the U.S. During the first quarter of the year, GDP slowed significantly because of a slowdown in consumer spending, downturns in inventory investment, and lower state and local government spending. CNBC reported that pedestrian first quarter growth pace, however, not a true picture of economic health. The labor market is near full employment. Consumer confidence is at multi-year highs, suggesting that the mostly weather-induced sharp slowdown in consumer spending is probably temporary. The Federal Reserve estimates that GDP will grow by 2.2% in 2017, will probably slow to 2.1% in 2018, and slow again to just below 2% in 2019. This, however, can change dramatically depending on the quality and the size of Trump's fiscal stimulus plan. Unemployment, which is referenced in the upper left chart, has declined dramatically in the U.S. during the past 5 years. Consumer sentiment, on the right, was strongly positive until June. From about June 8th through mid-month, the University of Michigan's survey reported sentiment dropped 11 points. The erosion in confidence was attributed to more negative perception of proposed economic policies among Democrats and the reduced likelihood of passage of these policies among Republicans. Inflation has remained stubbornly low, well below the Federal Reserve's target of 2%. Low inflation has been a bone of contention among many economists and analysts. In June, Minneapolis Federal Reserve President Neil Kashkari, a member of the Fed committee that determines interest rates, disagreed with the Fed's decision to raise rates. He wrote, "On one hand, intuitively, I'm inclined to believe the logic of the Phillips curve. A tight labor market should lead to competition for workers, which should lead to higher wages. Eventually, firms will have to pass some of these costs on to customers, which in turn leads to higher inflation. This makes intuitive sense." That's the faith part. On the other hand, unfortunately, the data really doesn't support this story, with the FOMC, that's the Federal Open Market Committee, coming up short on its inflation targets for many years in a row. And now, with core inflation actually falling even as the labor market is tightening. If we base our outlook on inflation on this actual data, we wouldn't have raised rates this week. Instead, we should have waited to see if the recent drop in inflation is transitory to ensure that we're fulfilling our inflation mandate. So there's a lot of confusion today about what interest rates are telling us. But that being said, so far this year, stock prices on many of the markets across the world have moved higher. One reason for strong U.S. stock market performance is that corporate profits have improved. Companies' profitability is reflected in their earnings. In the United States, during the first quarter of 2017, 75% of companies in the S&P 500 reported earnings that exceeded expectations. In aggregate, the S&P, the NASDAQ, the Dow companies produced between 14 and 18% in year-over-year earnings growth. This is the highest recorded since 2011. Important aspects of this quarter's earnings, according to a source cited by CNBC, is that earning gains have been driven more by reported revenue figures than by margins. In other words, we're seeing top-line growth. We're seeing more things being bought, more things being transacted than just simply an improvement in margin as a result of cutting expense, reducing interest rate expense, and so forth. So as you can see by the chart, some sectors of the market are certainly more profitable than others. While strong corporate earnings growth are a positive for stocks, a change in investor post-election expectations has negatively affected the performance of some market sectors. Betting markets reckon that Mr. Trump's chances of passing a corporate tax bill this year fell from 56% to 42% in May. Although stock markets remain at all-time highs, other indicators more sensitive to Mr. Trump's promises have started to reverse. Data from Goldman Sachs shows that when Mr. Trump was first elected, the stocks of certain companies did especially well, especially those paying high tax rates and those working in construction and engineering industries outperformed the overall market significantly. But as the president's chances of pushing through his policies have waned, so too have the firm's fortunes in the market. Bonds haven't really met expectations either. In fact, bond investors appear to have interpreted the economic data differently than stock markets and the Federal Reserve. Despite Federal Reserve rate hikes in December of 2016 and March and June of 2017, increases that theoretically should have pushed bond yields higher, the 10-year Treasury has actually moved lower. As you can see, that changed quite a bit in the last week of June, as referenced by the sharp spike up in the right-hand chart toward the very end of the chart. One big reason that bond yields remained low during the year is that investors were unconvinced rates would move higher. The Economist explained, in large part, falling bond yields reflected a growing conviction that short-term interest rates were unlikely to rise soon or quickly. Central banks are fearful of cutting short the synchronized global economic upswing, and with inflation benign, we see no real need to take risks. There are many of the central banks are buying lots of assets. The ECB and the Bank of Japan are acquiring more bonds and mortgages, and the Federal Reserve is still reinvesting. In short, little is afoot to upset the bull market move. As you can see in the table, interest rates have been relatively low across the globe. Of the 12 central banks shown, only 4 have raised rates in recent quarters. During the last week of June, however, statements from both the European Central Bank and the Bank of England were interpreted to mean that they might begin to provide less stimulus and increase rates soon. In response, Treasury rates bounced, bond prices dropped. Another reason bond yields may have remained low is the divergence between soft and hard economic data. This graph from the Federal Reserve shows a soft data series and a hard data series during 2017. The blue line is the University of Michigan's Consumer Confidence Index. The red and green line represent industrial production and retail sales. Each series is indexed to 100 as of October 2016. So as you can see, consumer confidence has risen much faster than either retail sales or industrial production. So, where are we now? In May, the economist pointed out investors appear to be bullish and skittish at the same time. The economist stated, in other words, investors are managing to be simultaneously bullish and skittish. By a large majority, fund managers expect global growth and corporate profits to be strong over the next 12 months. But they also know such expectations are already fully reflected in share prices. History suggests shocks have a nasty habit of occurring. So let's take a look at various aspects of this statement. It's true, markets have had a good run so far this year. Many financial markets have performed very well. The S&P finished the second quarter up 8.2% for the year. Dow Jones Global, ex the US, so predominantly international, up 12.6. Emerging markets up 17.2. Gold up 7.2. Commodities were down 5.6. And the Dow Jones Equity All Real Estate, or REIT Index, which represents real estate investments kind of across the board, a diverse mix, was up 4.9. Emerging markets have delivered strong performance this year. Goldman Sachs stated, after years of underperformance versus developed markets, emerging market equity and debt in 2017 are repeating their strong 2016 performance. The last several months have included a reversal of the sharp, brief Trump tantrum of losses and outflows following the U.S. election, and a wider recognition that emerging markets may have turned the corner. Stocks in emerging markets have been attractive, in part we believe, because U.S. stocks are a bit pricey. This chart from FactSet shows the trailing 12-month price-to-earnings ratio for the first quarter of 2017. It's well above the 5-year average of 17.6 and the 10-year average of 16.7. When PE is above average, there is a risk that stocks may be too expensive. Why are we investing if markets are highly valued, one might ask? According to The Economist, the conventional threats to the equity market are twofold: a sharp rise in interest rates, which would hit indebted individuals and companies, or a decline into a recession, which would dent profits. Neither looks imminent at this moment, which helps explain why Wall Street keeps hitting record highs. Another measure of valuation is the cyclically adjusted price-to-earning, or CAPE ratio, which averages profits over a 10-year period. In early June, the CAPE ratio was well above its mean of 16.76. In an April interview, Robert Shiller, Nobel Prize-winning laureate and Yale economist, as well as the creator of the CAPE ratio, told CNBC, "The U.S. stock market hasn't been this overvalued except for a couple times in history, around 1929 and around 2000. If you go back to 1998, you'll find that the CAPE ratio was about the same level as it is now, and it kept going up for the next 2 years. It got to something like 45 in the year 2000. We could go back up there. In other words, Dr. Schiller is saying, look, valuations are high, but they could go quite a bit higher because of relatively low inflation, improving corporate profits, and the specter of maybe even improving economic activity as a result of fiscal stimulus. When the S&P 500 or other indices are highly valued, there still may be some attractive opportunities to invest in specific sectors or companies. This chart certainly shows a wide disparity between the haves and the have-nots, those that have performed well, such as technology, and those that have underperformed, such as telecom or perhaps energy. Another area to look for opportunity is among value stocks. This mountain chart shows the relative performance of the S&P 500 growth companies and the S&P 500 value companies since 2008. Clearly, growth companies have outperformed. That's something of an anomaly according to British asset manager Schroeder Global. Over 100 years, then over 50 years, and over 20 years, history suggests that value strategies work. Over the last 10 years, however, there has been inarguably been a much better game in town, and its name has been quality growth. So does this mean that this time it's different? We don't believe so, because we don't believe human beings have stopped being human beings. However, there is some evidence that humans may have stopped being human somewhat. Investors have been superhumanly calm during 2017. This chart shows volatility indices, which are better known as fear gauges for the S&P 500 in the US, the Nikkei in Japan, and the stocks index in Europe. They are designed to reflect how much market volatility investors anticipate in coming months. The CBOE Volatility Index, or VIX, measures anticipated volatility of the S&P 500. It's only dropped below 10 on 16 days since the index was first introduced. From 1990 through 2016, the average of the daily closing values of the VIX was 19.6. Year to date, this is by the way through June 1st, that same index average has been 11.6. People are very calm about the expectation of volatility in the near future. But there is obviously no shortage of geopolitical shocks and concerns. Investors, though, have remained calm in spite of this. They were calm when the United States launched the military strike in Syria and when it dropped its biggest non-nuclear bomb on Afghanistan. They remained calm through terrorist attacks in Sweden and Russia and France and the United Kingdom. And they didn't flinch as the European Union unraveled and then the U.S. government flailed. And they didn't flinch much as the European Union unraveled or when the U.S. government flailed. 2017 could be dubbed the Teflon year. All this calm may very well be good for investors. Schwab looked back over the past 15 years and calculated returns for the MSCI World Index, that's the Morgan Stanley Capital Incorporated World Index, following periods of extremely low volatility. The data showed low volatility can be a harbinger of attractive short-term global returns, but there's not a whole lot of data to back this up. In fact, if we look at the chart, it suggests that in periods of time when the VIX average is below 10, which doesn't happen often, in the forward month, you can see returns of 1.7%. In the forward 3 months, a little over 2%. And over the forward 10 months, nearly 7.5%. So the CAPE ratio tells us that the U.S. stock market may be muted over the next decade or so, while the low levels of the CBO Volatility Index implies that global returns may be quite attractive over the short term. Of course, you should take the historical data with a grain of salt. The VIX levels have rarely been this low. So there's just not much data out there to support these conclusions. So, where are we headed? I wish I knew. I don't have a definitive answer about whether the story told by the stock market or the one told by the bond market will prove to be right. What we can tell you, though, is that we're in the midst of what we would call a synchronized expansion. The U.S. economy has been bolstered by solid labor markets, rising wages, positive sentiment. Two signs that suggest that we're in the middle to late stages of the current business cycle includes tightening of the labor markets, which may generate wage pressure and limit corporate profit margins, and a tightening of Federal Reserve monetary policy. We'll be watching for inflation signs. The global economy is expected to grow during 2017. We believe emerging markets should grow at a faster pace, more than many developed countries. Corporate earnings in the U.S. are expected to grow as well, which could help support share prices. The watchword for the remainder of the year is caution, as recommended by Russell Investments Outlook for the second quarter of 2017. Russell stated that our global team of investment strategists warn that investor expectations have run ahead of market fundamentals in the global equity markets. They maintain a call for caution as inflated expectations of global growth and U.S. fiscal policy drive markets higher despite looming global economic headwinds. In the medium term, we are not bearish. Schwab's June market perspective also recommended vigilance. Goldilocks appears to have arrived. Low interest rates, improving earnings, a strong labor market, calm inflation, and still accommodative monetary policy. But, as always, there are clouds on the horizon and pullbacks are possible at any time, so it's important for investors to remain vigilant in keeping a diversified portfolio with appropriate risk exposure. In keeping with the Goldilocks theme, we'll point out three potential pitfalls or bears worth watching: an economic slowdown, a domestic political implosion, or a geopolitical blowup. None, however, appear to be imminent, but either of the latter two could appear suddenly. Not everyone shares the sense of cautious optimism. In June, Dr. John Hussman of the famed Hussman Funds wrote that a return to normal valuations may be an unpleasant experience. He said, from the standpoint of downside risk, over the completion of the current cycle, merely touching historical run-of-the-mill valuations in the next few years would presently require a decline in the S&P on the order of 57 to 62%. Suffice it to say that a 50 to 60% loss in the S&P over the completion of the current market cycle would not be a worst case scenario, but instead a run-of-the-mill outcome. Not everybody is bearish as Dr. Hussman. In fact, Jeremy Grantham, who normally is much more pessimistic and less optimistic, doesn't anticipate a return to normal anytime soon. In fact, he seems to think that this market can continue to limp along for an extended period of time. The time frame he used was 20 years. So if we're nearly 10 years into this recovery, that means we could still see a fair amount of the same going forward. We're mindful of the opinions of others, and we plan to keep an eye on diverse issues for the remainder of the year. We'll watch political and economic events closely, as we always do. We'll also watch consumer confidence to see if it begins to change direction. Investor sentiment also will provide some data to gauge potential market performance. This is an interesting chart as it shows the percentage of Americans who were bullish, neutral, or bearish during 2016. The data is valuable because As Sir John Templeton once said, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Judging from the chart, it's hard to believe that we're in a euphoric state or even a state of accepted optimism. Of course, can't consider looking at economic data without taking a close look at central bank policies as well. From the Federal Reserve to the European Central Bank to the Bank of Japan, changing monetary policy has the potential to profoundly affect market performance. In particular, we'll be watching to see how the Fed unwinds its balance sheet. David Kelly, Chief Global Strategist at JP Morgan Funds, recently told Barron's, "While I don't believe quantitative easing succeeded in spurring stronger economic growth, it probably did succeed in depressing long-term interest rates, and an aggressive path of reverse QE, particularly when accompanied by steady increases in federal funds rate and less easy central banks overseas, will very likely push long-term rates higher over the next few years. While still, low inflation should limit the backup in yield. It will likely feel a little worse than paint drying for investors heavily allocated to the long end of the Treasury market." So let me interpret. What Dr. Kelly is effectively saying is simply this: bonds are not a great investment to be in when interest rates are rising. However, because of relatively low inflation and a rising interest rate environment, we don't expect the same amount of damage to be had by long-term bondholders as we would have seen in other periods of rising interest rates. Well, look, we spent quite a bit of time this morning talking about the economy, where we are, where we've been, and hopefully where we may be going. But just as important, however, is for us to have a better idea what's going on in your lives, and more importantly, how your lives may be changing or to be changed for the rest of the year. Maybe there's a marriage or a new grandchild on the way. Maybe an illness is creating unexpected financial issues. Life changes play an important part in determining the financial strategy that'll be right for you. So please let us know what changes you expect for the remainder of 2017. And as always, we're here to help. Thank you very much for your attention. If you have any questions at all, please give us a call. And as always, thanks for your continued support.